Good morning, and welcome to the December 2025 meeting of the SEC's Investor Advisory Committee. I am Brian Shore, and I am chair of the IAC. Before we get started, I'd like to turn the microphone over to Andrew, who will conduct a roll call, to Adam rather, who will conduct a roll call.
James Andrus.
Here.
Rodney Comingus.
Here.
James Copland.
Present.
Gina Gale Fletcher.
Here.
George Georgiev.
Here.
John Gulliver.
Hello. Sorry, I had you on mute. I didn't realize it.
Colleen Hoddensberg.
Here.
Craig Noki.
Here.
Christine Lazaro. Currently, as we'll follow up. Nancy Lamond.
Here.
Christine Martin Fervita.
Here.
Amy McGarity.
Here.
Andrew Park.
Here.
Dr. David Roney. Absent. Sergio Rodriguez.
Here. Sorry. Here.
Paul Roy.
Here.
Brian Shore.
Here.
Andrea Sight.
Here.
Alvin Veliquez.
Good morning. Here.
That concludes the roll call.
Thank you, Adam. Today's meeting features 2 panel discussions and 1 recommendation. Our schedule will take a slightly different format from prior meetings, so let me quickly highlight what we have planned for today. We will begin with opening remarks from Commissioners Peirce and Crenshaw. We will then have 2 panels. The morning panel, Corporate Governance from 10:25 to 12 noon, will be moderated by James Andrus. James is chair of our Investors Purchaser Subcommittee and a former vice president of public policy and former head of global sustainability strategy at Franklin Templeton. In 2025, the SEC introduced significant changes to the evolving corporate governance landscape. The changes impact how shareholders engage and how they interact with issuers and how boards respond to shareholder concerns. Key areas of change include amendments to the shareholder proposal process under 14A8, the use of mandatory arbitration clauses, investor and corporate engagement, and modifications to the proxy voting system. This panel will explore the evolving corporate governance landscape and is comprised of experts with various perspectives on the corporate governance ecosystem. Following the morning panel, Chairman Atkins will deliver his remarks from 12:20 to 12:30. We will then break for lunch and an administrative session from 12:30 to 2, after which the afternoon panel, Tokenization of Equity Securities, will commence at 2 p.m. The afternoon panel will be moderated by Andrew Park and John Gulliver. Andrew is the chair of the IAC's Market Structure Subcommittee and the Director of Federal Affairs at the New York State Insurance Fund. John is Executive Director at the Committee on Capital Markets Regulations and the Program on International Financial Systems and a member of the Market Structure Subcommittee. The topic of the second panel, as we said, is tokenization of equity securities. Now, tokenization is the issuance of a token representing ownership of an asset on a blockchain. This panel will explore the potential ways tokenization can improve how public equities are currently issued, traded, and settled, while addressing how existing investor protections and securities laws apply. Different forms of tokenized equities may carry different ownership rights related to voting and receipt of dividends, and our panelists will share with us their views on the issuance and trading of natively issued securities and wrappers. The panelists will also be examining the applicability of Reg NMS to tokenized equities, the interoperability of tokens issued across different blockchains, and other key market structure issues, including settlement and short trading and short selling. Following the afternoon panel, we will have remarks from Commissioner Ueda from 4 to 4:10, after which the members of the Investor Advisory Committee will consider a recommendation of our Disclosure Subcommittee regarding disclosure of artificial intelligence's impact on operations. I look forward to the insightful discussions ahead, both within the panels and concerning our recommendation. And now we'll turn to opening remarks from Commissioners Peirce and from Commissioner Crenshaw. First, I will call on Commissioner Peirce for her opening remarks. Commissioner Peirce, are you on the line?
I am. I'm sorry.
Okay.
I am here.
Thank you.
Well, thank you, Brian, and thanks to the committee members and the panelists for being here today at the advisory committee's last meeting of the year. Before discussing today's agenda, I want to thank Christina Martin-Fervita, whose dedication and passion for her job and commitment to investors has greatly benefited this committee, the commission, and investors. Today is her last IAC meeting as the commission's investor advocate. Christina has served as the Commission's second investor advocate for the last 3 years, and I've greatly enjoyed working with her, and particularly have appreciated her willingness to brainstorm on any issue of concern to investors, even the hard ones that everyone else tries to avoid talking about. We're a week past Thanksgiving, and I'm wondering if I will ever reclaim my refrigerator. Leftovers still occupy every shelf and have spilled into my backup refrigerator, aka my balcony. I'm paying for my overly ambitious menu planning. Maybe I should have concentrated on making fewer dishes of higher quality. Then my guests would have eaten more, and I would not be eating mashed potatoes, stuffing, and cranberry sauce for breakfast for the foreseeable future. This experience got me thinking about corporate governance and shareholder engagement, which happens to be on the menu for our first panel today. When it comes to shareholder engagement with corporations, some people seem to believe that more is always better and that quality does not matter. In this view, every shareholder deserves, as often as she likes, to have her concerns, as many as she has, aired on the corporate ballot, discussed in corporate boardrooms, and reflected in corporate budgets. But, as my former colleague Elad Roisman noted, while we all have a right to get on our soapboxes, we have no right to force others to pay for them. Where the SEC has a role to play in shaping corporate governance, those rules should recognize both the benefits and the costs of shareholder engagement. Rules should provide avenues for shareholders to be heard when they speak to the mutual interests of the company and its shareholders writ large. On the other hand, rules should dissuade shareholders that seek to deprioritize financial return as the sine qua non of corporate purpose. Amplifying those voices could drive companies into the treacherous terrain of catering to shareholders' idiosyncratic objectives, which may undermine rather than enhance corporate value. A well-calibrated rule set gives shareholders a voice in proportion to their alignment with the corporation. Therefore, I support broad shareholder engagement by enabling all shareholders to enter standing proxy voting instructions. And mechanisms like that facilitate shareholder voting make sense and may save the company money that would otherwise have been spent on drumming up votes to meet quorum requirements. I also supported the Commission's recent acknowledgement that mandatory arbitration provisions do not run afoul of the federal securities laws. Shareholder litigation, even when it is baseless, costs companies a lot of money and time, so some companies and their shareholders may prefer resolving their disputes through arbitration. The SEC should not override their preferences. Finally, eligibility to submit a shareholder proposal under Rule 14a8 should be limited to shareholders whose interests align with those of the corporation. Otherwise, shareholders, in order to extract special interest concessions from the company, will submit shareholder proposals which divert company time, attention, and resources. The second panel is linked to the first because, among other benefits, tokenization could facilitate informed shareholder engagement by making it easier for companies to communicate with shareholders and for shareholders to vote. More generally, the tokenization of equity securities has the potential to transform how securities are issued, traded, and settled, and empower investors by giving them more direct control over their assets. Investors will benefit from near instantaneous settlement, reduced counterparty risk, enhanced transparency through immutable ledgers, and lower transaction costs. At the same time, tokenization raises a host of interesting legal and policy questions. For example, tokenization models vary widely. On the one hand, issuer-sponsored securities issued directly on the blockchain networks maintain full integration with master security holder files. They preserve traditional ownership rights while enabling direct ownership. Conversely, third-party sponsored tokens, depending on how they are structured, may provide synthetic exposure to an equity's price movements through derivative instruments, such as through tokenized structured notes or security-based swaps, but offer no ownership or voting interest in the issuer. Additional questions arise because technologically savvy investors will be able to buy, sell, and hold assets without a traditional intermediary or without any intermediary at all. Determining how to fit this activity into our rulebook, which is built around intermediaries, is challenging. Some rules may not be necessary to advance the regulatory objective that those rules ostensibly serve, given distributed ledger technology's ability to reduce certain risks and enhance transparency. We do not have the luxury of time in tackling these questions. Tokenization of US equities is already happening. Anybody can spin up a liquidity pool or launch a trading protocol that enables investors to get exposures to our equity markets. Only the quick, careful, and creative development of a workable regulatory framework for the issuance and trading of tokenized securities that provides American investors with protections that they have come to expect when trading US equities is the answer. Otherwise, American investors will buy tokenized securities overseas. Commission staff is working on a tailored innovation exemption that would permit this activity in the United States with strong investor protection guardrails and this would be subject, of course, to the Commission's oversight. As we embark on this important discussion, I encourage our panelists today to consider several key questions that will help shape our path forward. These questions don't have easy answers, but addressing them thoughtfully will be essential as we work to create a regulatory framework that both protects investors and allows innovation to flourish. Here are the questions. First, are we adequately considering the full range of emerging tokenization models, and are there additional benefits or drawbacks the Commission should consider that are unique to certain models? What are the broader implications for fundamental market mechanics like settlement processes and short selling? What parts of our existing rulebook simply do not work for this emerging market structure? For instance, should Reg NMS apply to tokenized equities in its current form? How do we ensure interoperability across different blockchain networks while maintaining the market integrity on which investors depend? What might an appropriate tailored innovation exemption look like? What type of activity should it permit? What conditions would be both necessary and workable? Looking longer term, how can we build a regulatory framework that is fit for a future where intermediaries have less sway and investors exercise more autonomy as they move through our markets? Another captivating technology is the subject of the final discussion of the day, artificial intelligence. The committee will discuss a draft recommendation about public company disclosures related to AI. In some ways, the committee's discussion is timely. AI has been a theme of 2025, eye-popping valuations of AI companies, hopes for AI's ability to increase productivity, questions about how AI will affect companies' hiring needs, and fears about AI's ability to turbocharge cyber criminals. But in other ways, today's discussion is just the latest version of the evergreen tug of war between principles-based rules and prescriptive rules responding to the hottest issues du jour. Principles-based disclosure rules allow companies to tell investors how they are approaching challenges and opportunities, while companies following prescriptive disclosure mandates merely fill in the blanks of the SEC's script. I look forward to your discussion and have several questions for your consideration before you finalize the draft recommendation. The draft recommendation laments that current disclosures related to AI are uneven and inconsistent, and that practices vary significantly among industries. But are such differences problematic? A small, recently public company with only a handful of employees, for example, certainly has a different relationship with AI than mature global companies with thousands of employees. If company and industry adoption of AI is not entirely homogeneous, why should our disclosure regime force conformity? Would any attempt to do so open the Commission up to critiques similar to those leveled against the SEC for its predictive data analytics proposal, which critics feared would chill advisors and brokers' use of AI and other technologies? Is this an area where prescriptive disclosure requirements would shape corporate behavior, which is not a proper role for merit-neutral SEC disclosure rules? For example, a requirement to disclose board oversight, if any, of AI implementation and utilization could nudge companies to set up a superfluous AI oversight function. Why did the committee include a materiality qualifier in only the third prong of the draft recommendation? Such a qualifier is entirely sensible here, as it is with our existing disclosure rules. In fact, I would contend that absent a congressional directive to the contrary, the SEC doesn't have the authority to mandate immaterial disclosure. The committee notes that participants from a prior panel held by the committee agreed that the commission should give guidance on the definition of AI so that issuers know whether they're using AI in the first place. Even if we draw in a definition drafted by another agency, why should the commission attempt to define the limits of emerging technologies? Why not leave that task to the companies using these technologies? Thank you all once more for your willingness to dedicate so much of your time to the IAC. Thanks to Christina and her staff for their work with the committee, and I'll hand it back to you, Brian.
Thank you very much, Commissioner Peirce. Next will be Commissioner Crenshaw for her opening remarks.
Good morning. Thanks, Brian. And welcome to the members of the committee, as well as all of the panelists. This is the final IAC meeting of my tenure as SEC Commissioner. So this morning's meeting is a little bittersweet for me. But with that in mind, I do want to first and foremost express my sincere gratitude to all of the members of this committee, as well as all of those who've served before you. These are not mere platitudes. Your work on behalf of Investor is deeply important. It's meaningful and tireless. It's thoughtful and balanced. And you do this work in your free time, even though for many of you, it could actually be a full-time job. You bring diverse expertise to the table, as well as the clear-eyed common goal of making the markets better for investors, so that Americans of all stripes can live their own versions of the American dream. That is no small task, but it's one that you all have approached with steel and grace. And I want each of you to know that I've listened to your recommendations, and they have universally improved our policymaking. As you move forward, I hope you will continue to bring energy and enthusiasm to the tasks that lie ahead. As the Commission will no doubt continue to deregulate in the months ahead, please act as a voice for those investors who can stand to benefit from those rules that will be threatened with potential revision or repeal. I have no doubt that you are up for those challenges. And for my fellow commissioners, I hope that you will continue to seek a diversity of viewpoints as you select committee members in the future, because I believe sincerely that a robust and potentially dissonant discussion leads to more considered policy advice and outcomes. Another big thank you to Christina, who leaves us at the end of next month. Christina, you have been a leader and a friend, and your work will benefit investors well beyond your time here. The agency will miss you. I wish you great successes in your future endeavors. So shifting gears, there's no better topic to underscore the important work of this committee on behalf of investors than the changing corporate governance landscape. In under 1 year, this landscape has shifted dramatically. Staff rescinded Staff Legal Bulletin 14L, making it easier to exclude certain shareholder proposals. Staff has determined not to weigh in on the majority of no action requests as part of the 14AA process, except that it will issue no objection relief to those who ask for it, based on no substantive review of underlying requests. The chairman has indicated that the commission will greenlight the exclusion of most precatory proxy proposals, based not on changes in state law, but on the speculation of certain Delaware practitioners. The commission has issued a policy statement effectively permitting public companies to employ mandatory arbitration clauses to prevent shareholders from litigating either their singular or class action claims in federal court, not leaving the decision up to them. Staff has granted no action relief to allow retail investors to check the box to a standing instruction that automatically votes their shares in conformance with board recommendations without individual consideration of specific issues, including potentially merger or divestiture votes. Staff has issued guidance under Rules 13D and G that limit investor interaction with management in an effort to chill those communications. And as stated by the chairman, we know it's his intention to seek to reduce the cadence of quarterly reporting requirements and diminish disclosure in areas such as executive compensation. And that's just the beginning. Any one of these changes would be groundbreaking. Together, they represent a seismic shift in the corporate governance landscape happening right under our feet. And yet, as many of my colleagues know because I keep reminding everyone, not a single one of these changes affected to date has been through notice and comment rulemaking. That means that we have not had the benefit of statutorily mandated economic analysis to assess the impacts of the deeply important policy shifts that we're making. We haven't measured the economic costs or benefits of a single change, and we certainly have not measured the cumulative effect of these policy changes, which I've been told repeatedly in the past is important to members of industry. Moreover, we have not benefited from the considered feedback of impacted investors. Investors who will have fewer disclosures, less input over how the management of the companies they own put their investor dollars to work, and potentially fewer, if any, avenues of redress when they are victims of fraud. Indeed, all of these changes lopsidedly inure to the benefit of management and to the detriment of shareholders, corporate accountability, and the governance structures that provide checks on corporate decision makers. That's why today's panel is so timely and so important. Help us understand both the singular and cumulative impacts that our deregulatory efforts in this space will have on investors. Bring data, analysis, and precedent to the conversation. Help lend a voice to investors who didn't have the opportunity to weigh in before these changes were made because the Commission chose to leave them out in the cold. I'm also looking forward to today's panel on tokenization, which will tackle the many challenges associated with tokenized equity products. As I've said before, tokenization raises a host of complex, novel issues on how tokenized securities could be issued, traded, cleared, and settled. Altering established regulatory standards to accommodate these novel processes would carry significant risk, both to market integrity and to investors. At the same time, new rules may be warranted to address these products' unique risks. For example, tokenized equities are commonly marketed as wrapped securities that provide exposure to an underlying asset. Some are touted as expanding access to assets, such as private company shares, that are typically inaccessible to retail investors. But in truth, these tokenized products are far from a one-to-one replica of the underlying asset to which they are supposedly linked. The ownership rights and entitlements are different, often unclear, and potentially entirely unconnected to the issuer of the underlying asset. They're generally less liquid than traditional securities and much harder to price and trade. How can investors or their advisors fairly evaluate the risks of these wrapped tokenized securities? Should the regulatory requirements that govern them be relaxed just because the product exists on a blockchain? Do wrapped tokenized securities offer any clear benefits to investors that may justify their heightened risks? Most importantly, what are we actually trying to achieve by tokenizing equities in secondary markets? If the purpose is to achieve settlement efficiencies, then that presents a much different use case than if the purpose is to allow tokenized equities to trade without any front-end investor protections, which would create an environment ripe for regulatory arbitrage at the expense of the traditional equities markets. If this new ecosystem does not provide either common market transparency about price or visible market protections, I ask again, what is the goal and the likely outcome here? These are difficult and complex questions, and I look forward to hearing the panelists' views. Many thanks again to the committee for both your hard work leading up to today, including what I thought was a very helpful recommendation on disclosures around artificial intelligence, well thought through, well balanced, and really important again for investors, those who this committee represents, and giving us a sense of what will be useful for those who use those disclosures on a regular basis. And I thank you in advance for your continued work in the future. I sincerely hope our paths will cross again. Thank you.
Thank you, Commissioner Crenshaw. I too want to thank you for your insights, your support of the IAC, and your support of investor rights and protections. And we all wish you all the best in your future endeavors. Thank you again. Let's now turn to the next item on our agenda, which is the approval of our minutes from our September 18, 25 meeting. Those minutes have been circulated prior to today's meeting. Do I have a motion to approve the minutes?
So moved.
Can I get a second?
Second.
All in favor?
Aye.
Aye.
Any
Aye.
objections? The minutes are approved. Wonderful. Let's now turn to our morning panel on corporate governance. Again, we will have until approximately 12:20 on our panel discussion, and the panel will be moderated by James Andrews. James?
Thank you, Brian. And I'd like to thank Chairman Atkins and SEC commissioners and my fellow members of the Investor Advisory Committee. It is a privilege to moderate this discussion on how the Securities and Exchange Commission's 2025 corporate governance changes will impact investors, boards, and markets in the coming years. Over the past year, the Commission has taken action on several fronts with respect to investor rights and corporate accountability. Key changes have been made to mandatory arbitration of federal securities claims, the shareholder proposal process under 14A8, the SEC staff's no action role, as well as approaches to proxy voting and proxy advisors. Taken together, these developments will significantly impact the corporate governance ecosystem. One closely watched development is the ExxonMobil Corporation's no action letter, which effectively greenlights a new retail standing voting instruction program. Under this program, retail shareholders can opt in to have their shares voted automatically in line with the board's recommendations, a model that could increase retail voting participation, but also could shift voting power and influence from workers and investors to management and boards. The SEC first established the framework for the shareholder proposal process in 1942 and later developed a compromise permitting advisory or precatory proposals. However, it has now raised the question of whether such proposals are permissible under state law. At the same time, the Division of Corporation Finance has sharply revised how it will handle shareholder proposal no action requests in the 2026 season, signaling that companies may be able to exclude more proposals based on their own reasonable basis. With staff substantially stepping back from providing no action letters, as had been the practice for decades. Together, these moves create uncertainty regarding how the shareholder process will work in 2026. In parallel, the Commission's due policy statement on arbitration provisions has reversed a long-standing informal bar and removed the key obstacle to public companies embedding mandatory arbitration of securities claims in their governing documents. This shift could reduce class action litigation risk for issuers, but may also limit the practical ability of investors, especially small investors, to seek relief through collective court actions, raising questions about deterrence, accountability, and the balance between capital formation and investor protection, leaving the final answer to state law. All of this is unfolding against a dynamic backdrop in proxy advice and stewardship. Major proxy advisory firms and large asset managers are adjusting their methodologies, engagement models, and voting policies for 2026 and beyond, including evolving approaches to executive pay, board composition, and environmental and social issues. These shifts will interact with the SEC's rules and staff guidance in ways that could either amplify investor voice or, if not well understood, add another layer of complexity and fragmentation for both institutional and retail investors. To help us unpack this complex and fast-moving landscape, we are fortunate to be joined by an outstanding panel. Nell Minow brings decades of experience in corporate governance and shareholder advocacy across markets and cycles. John Coates offers deep regulatory expertise and an academic perspective on how these changes fit within the broader evolution of federal securities law. Brad Goldberg counsels issuers and boards navigating these rules in real time. James McRitchie brings the long view of a retail and governance activist. Elizabeth Bieber advises companies through high-stakes proxy seasons and contested situations. Finally, Severin Norvert will help us connect these legal and policy shifts to the day-to-day realities facing global long-term institutional investors and the beneficiaries they serve. With that, let me start by asking Nell to frame how these changes look from the perspective of longtime governance advocates and what she sees as the most significant inflection points for shareholder rights heading into 2026.
Thank you very much, James, and thank you to everybody for inviting me today. There is so much going on here that I'm going to have to begin by mixing my metaphors. I'm going to begin with the forest and the trees. It's really important as we are looking at the overwhelming assault on shareholder rights and access to information that we keep our eye on both the individual elements and the big picture. And then, therefore, the second metaphor is whack-a-mole. There is so much coming at us. We have to be aware at all times that there is more coming at us on all sides. The focus is on shareholder access to information, shareholder rights, shareholder access to independent analysis. If there were a movie to explain where we are right now, it would be The Empire Strikes Back, because all of this dates back to ExxonMobil. It's not a coincidence that ExxonMobil is out front in trying to basically be both the umpire and the hitter and the pitcher in the same game by taking back the right to vote shares on behalf of the shareholders. It's because of ExxonMobil and the engine number one proxy contest that American corporations have become so frantic about this that they're just avalanching money to lobbyists to get all these changes. Remember that those who love to rhapsodize about the purity of the free market turn into snowflakes when they don't like what the free market has to say. So we've seen attacks at the state level and at the federal level. We've seen attacks on regulatory and legislative initiatives. Most recently, just this week, Ted Cruz announced a proposed legislation that would stop the biggest pension fund in the United States, the Federal Employees Pension Fund, from voting in favor of DEI or ESG proposals. Let's just go back for a minute to the origins of the Federal Employee Pension Fund, when it was in the enabling legislation that no federal employee could vote the proxies because they felt that there was a conflict of interest. If you're regulating an industry, you might want to go soft on them if you're also a shareholder. So here we have come full circle, and now it's getting political again. Another reminder, where did all of this start? Where did the proxy advisors start? It's because in the 1980s, the first time that really major issues were widely presented to shareholders during the go-go years of leveraged buyouts and securities to make any kind of hostile takeover possible, portfolio managers were going into the tank if the portfolio company was also a client of the firm. And that's why independent sources of information, the proxy advisors, became so important. You know, Commissioner Peirce, when she speaks about idiosyncratic proposals and proposals that are not important, forgets the extremely limited scope of subject matter on proposals. You can't do anything that is about ordinary business, and you can't do anything that isn't sufficiently connected to the company. That really leaves us with overall strategic and governance issues, which I think are very appropriate for shareholder oversight. I went to the University of Chicago. I'm a strong advocate for the free market. That's why I've worked on behalf of shareholders for 40 years. And shareholders do not need regulators deciding what is material or what information they want. That is, these are people who make those decisions all the time. They should know what they want. Ever since the beginning of shareholder proposals in the 1940s, as James mentioned, it's really been a lot of individuals like Jim McRitchie who have submitted most of the proposals, but that's not the question. The question is, how much support do they get? And if they're getting 40, 50, 60% of the vote, that shows that it's a very healthy system. Non-binding shareholder proposals are the most cost-effective way for shareholders and issuers to communicate. And if that option is further limited, I can promise you what is going to be left is going to be much more complicated, much more expensive for everybody. We're going to see a lot more votes against boards. We're going to see universal proxy used more often. We're going to even possibly see denying the company a quorum. So they'll have to have another annual meeting until they get it straight. Restrictions on proxy advisors that are being proposed limit new entrants when what you want to do is encourage new entrants. We've had them all the time. Vivek Ramaswamy started an anti-woke proxy advisor service. And so you want to encourage competition, not limit it. What we should focus on instead, I think, is proxy plumbing. I think we can all agree it's very outdated. That should be a priority. And we should remember that what made the US capital markets the envy of the world, because in increasingly seamless global markets, it's of urgent and vital importance that we maintain our position as the most transparent and the most friendly to shareholders. It's not just this committee that is the advocate for shareholders. It is, after all, the slogan of the commission, and it's important that we remind them of that.
Thank you much, Nell. I will next turn to Brad. So Brad, you've heard the earlier conversation during the IAC meeting. So does the SEC's evolving stance on shareholder proposals, engagement, arbitration clauses, and retail voting programs mark the end of corporate governance and shareholder democracy?
Thanks, James. I hope everyone can hear me. I'm having a video problem, so you can't see me. I apologize for that. Maybe some people will think that's perfectly okay and be happy about that, but I apologize. So I think the answer to the end of corporate governance and shareholder democracy with some of these changes that are coming out is a pretty resounding no. I would actually argue that the regulatory shift will allow companies to focus more on corporate governance. Boards take their oversight responsibilities more seriously than ever right now. You know, we have many clients that voluntarily adopt corporate governance changes, such as declassifying the board, allowing stockholders to call special meetings, et cetera, before they ever receive a shareholder proposal. And shareholder proposals are only one lever in the corporate governance landscape. And unfortunately, the 14A8 process has been, largely co-opted by a small subset of special interest groups that submit environmental, social, and political proposals, often with little regard for enhancing long-term shareholder value. These proposals are a costly distraction and not a good use of company resources. The current process also imposes significant costs on institutional and retail investors who have to wade through the growing volume of proposals that are submitted each year. Getting back to the original intent of Rule 14A8, which was never meant to apply to general social and political issues, should actually allow for more focus and attention on corporate governance matters, as such proposals will not be lost in the deluge of special interest proposals that currently dominate proxy statements. In addition, concerns regarding disenfranchisement of shareholders, I think, are premature. We should really let this proxy season play out with these new changes rather than jumping to conclusions. Perhaps counterintuitively, I think we may see more shareholder proposals on ballots this year than less. Companies right now seem hesitant to seek a Delaware court opinion to exclude the precatory proposals, and due to litigation concerns, may allow proposals that they would normally try to exclude through the no action relief process to go to a vote rather than exclude them unilaterally. And lastly, I think, as we'll talk about more later, in my view, retail voting programs actually serve to enhance the shareholder franchise, not disenfranchise it.
Thank you much, Brad. Next, I will turn to Severine. Severine, you represent ICGN, and ICGN represents asset owners and managers from around the world. How are the recent regulatory changes in the US being perceived by global institutional investors?
Thank you, James, and thank you, everyone. Good morning. Thank you for inviting me to speak today. It's a great honor to join you virtually. So, as some of you may know, the International Corporate Governance Network represents investors with over $90 trillion of assets under management. And we work to promote high standard of corporate governance globally. Our members, both asset owners and asset managers, have significant exposure to the US market, as you can imagine. I would like to start by reminding you that investors, companies, regulators all have a shared interest in efficient and resilient capital markets. Of course, this enables businesses to access long-term capital, support innovation, create jobs, while also generating the returns on which pension funds and citizens depend. And capital markets flourish when investors are confident that their rights are respected and protected, and that companies are operating with integrity and oversight. So I appreciate the opportunity to share the perspective of global investors. ICGN members are increasingly concerned, James, to answer your question, about what they view as an erosion of shareholder rights in the United States, a trend that risks weakening America's position as the world's leading destination for global capital. So we strongly encourage the SEC to continue safeguarding shareholders' ability to act as responsible stewards, as this is their fiduciary duty. Investors must be able to engage with boards, vote on key issues, file shareholder resolutions, access reliable information, and also use litigation as a last resort sometimes. So let me give you a few examples of recent developments that have caused strong concerns among ICGN members, and some of which have already been mentioned, of course. Shareholder proposals, we are deeply concerned by the recent announcements from the division that it will not respond substantively to most Rule 14a8 no action requests this proxy season. Shareholder resolutions are vital mechanisms through which company owners can raise ideas and concerns with management and all shareholders. So they are not indeed the only tool, they are not the only way, but they've been quite instrumental in driving improvements to corporate governance in the United States. And for decades, issuers and investors have relied on SEC staff guidance. Although advisory, it has been an independent and trustworthy check that gives procedural clarity. And it has helped curb the potential for arbitrary exclusion of shareholder proposals by boards of directors. So by stepping back from the process, the SEC risks significantly reducing shareholder influence, but also the important checks and balances that protect the long-term interests of the company and its owners. And as Nell mentioned, there is the risk that we will see increased opposition from investors through votes against board of directors, and that perhaps companies will be exposed to increased litigation. So you limit the constructive channels that are in place for investor expression, and that I think there is risk that the new framework escalates tensions between the company owner and management, which is really, I suppose, not intended. Another thing that has been a source of concern, and we raise it with the SEC, is the new clarification on Regulation 13D-G with the CNDI published in February. Investors have felt unable to indicate potential voting intentions or clarify their previous voting decisions in meetings with companies. And I think this has left companies less informed and perhaps unable to clarify some misunderstandings in the dialogue with investors. So it has diminished, I would say, a candid conversation. And it had disrupted the feedback loop that everyone benefits from. So for ICGN members, engagement is not adversarial. It's meant to be collaborative, transparent, and based on mutual understanding. Mandatory arbitration were also mentioned earlier, and I won't go into the detail, but I think the new policy shift can really constrain investors' ability to seek redress. They often preclude collective actions and move disputes into private forums that do not create the legal precedent. So you erode transparency, legal certainty, and market discipline. And for investors, especially minority investors, seeking remedies through public courts is a cornerstone of shareholder rights. So we encourage the Commission to maintain a role in scrutinizing arbitration provisions during registration. I will try to be faster, but of course the role of proxy advice is important. We hear a lot of misconceptions regarding how proxy advice is used by investors, so I would be happy to discuss that further. But I think we need to clarify that proxy advisors do not vote, investors make the voting decision. So I would like to just finish this opening statement by talking about the lack of public consultations. We strongly encourage the Commission to consider returning to public consultation processes on matters that substantively alter policy. The absence of public consultation on such important announcements, which may negatively impact shareholder rights, risk lowering the quality of the due process and the governance standards in the United States, thereby presenting a risk to the attractiveness of the capital markets. Thank you so much.
Thank you very much. Next, we'll have James McRitchie, the publisher of corpgov.net and a substantial participant in the shareholder proposal process. Jim, what recommendations do you have for the SEC IAC on where the SEC should focus its efforts over the next year to promote a healthy dialogue between shareowners, managers, and boards?
Well, thanks very much, James. And it's really an honor to be here. I think the last time I testified before the SEC was maybe 10 or 15 years ago with Nell, and was also there. And we covered many of the same topics, unbelievably. So I think the SEC should focus on one core priority with regard to retail investors, and that is to protect and amplify the voice of ordinary shareholders. So proxy voting remains a genuine two-way dialogue, not a monologue with management. I've submitted 3 documents highlighting different pressure points. Document A explains Rule 14A8 thresholds limit proponents to the top 1 to 3%. Now, this is based on a look at realistic portfolio sizes, diversification, normal diversification of portfolios, and the holding periods required. So the shareholder proposal process right now is very much limited to an economic elite. And what I understand is the Commission is thinking about raising those thresholds once again. I think that would be a big mistake. Millions are encouraged to engage through phone apps and pass-through voting. Those are positive moves, but voting is meaningless without real choices. Without shareholder proposals, in most cases, it's just uncontested slates and boilerplate items, unless we have a fight for control. And if we eliminate the shareholder proposal process, believe me, there'll be more fights for control. So first recommendation is don't raise the thresholds. Proposals are essential to trust and participation in markets. And I'm reminded that 20 years ago, I was sent by the State Department to Japan and Korea to open up their markets. And what was the message? The message was to allow shareholders a voice. So document B, retail owns about 30% of the shares, but we vote only about 10% of the shares. It's a very cumbersome process. I've got a lot of shares in a lot of different companies, about 300 companies. It's to look through all those proxies and try to vote them one by one. That's horrendous. So what we need is, and meanwhile, investors, they can cast their votes automatically, consistently across issuers. And Exxon got this auto voting blessed in a no action letter. That illustrates the asymmetry here. Retail shares can be automatically voted with management, even though Rule 14A-4 on its face prohibits this practice. So I would like to ask the Commission to modernize proxy rules to allow retail investors to use standing voting instructions, SVIs, that reflect their preferences. And I outline in this paper a number of safeguards that should be included. Document C is from the Shareholder Rights Group. It addresses acute threats. The framework that's governed shareholder proposals for 80 years appears to be being dismantled. And we request that the IAC urge the Commission to restore substantive no-action review, or at a minimum, systematically gather data on the consequences of its suspension. We also ask that they reaffirm that advisory proposals are proper subjects for shareholder action. And the SEC should clarify the narrow circumstances in which state law can preempt 14A8. They should also commit to transparent rulemaking rather than underground rulemaking through speeches or staff bulletins. In summary, don't further restrict who can file proposals. Give retail investors the tools to vote consistently through SVIs. And third, stabilize the federal framework that's allowed shareholders, managers, and boards to engage in constructive dialogue for generations. If the Commission pursues those three priorities, it'll protect the rights and voice of today's investors, sustaining the legitimacy of the system for millions of shareholders now entering our markets. Thank you.
Thank you very much, Jim. Next, we'll turn to Elizabeth Bieber. She's a partner and head of shareholder engagement and activism defense at Freshfields in New York. Elizabeth, with all of the changes in the corporate governance landscape over the last few months, what are the pain points that issuers have been experiencing?
Thank you, James. It's an honor to be here with you today on the panel. I think one of the pain points that we've been identifying over the last few months, and perhaps even years before that, is the tendency to approach companies as a monolith or have very limited buckets of company types. The monolithic approach can strain companies who try to fit into a one-size-fits-all approach to governance and to regulation. And we also know that investors, too, suffer from being treated like monoliths. One of the things that emerged in the last proxy season is, with some pullback on pressure from the stakeholder community in some ways, it actually permitted companies to have a little bit of breathing room to decide what is most important for them. How do environmental and social issues fit into their strategic plan? How do they reflect their strategic plan to their companies? And like Brad, we have also experienced companies really taking the reins of considering what best-in-class governance means for them. It was important to have companies feel like they didn't have the pressure to satisfy their oversight and fiduciary duties through external pressures. We've also seen that some of the changes in the recent months are perhaps a reflection that the monolithic approach isn't quite working anymore. Both of the most prominent proxy advisors have made changes that demonstrate that they're acknowledging the broad brush approach perhaps needs to change. ISS recently released their revised guidelines on environmental and social proposals, taking a more case-by-case basis instead of a recommendation for the proposals. Glass Lewis made changes that it announced that in the next couple of years, it will switch from having a one voting guideline approach to having voting guidelines that are more set by investors, demonstrating that investors too are craving a less monolithic approach to their own voting. In the governance space, I think companies are feeling sometimes a little bit constrained with their investors as well, who approach them in a monolithic way. Sometimes the investors' own proxy voting guidelines treat companies as if they are not able to determine what best-in-class governance means for the companies. And companies face tensions between, having PMs who select how much to buy, when to buy, what to buy, and then the governance arms which say, well, despite the fact that our PMs may love you and may be on a buying spree, And despite what your returns may be saying for the investors, we nonetheless are going to vote against your directors because of something like long tenure or overboarding, even when there is no evidence that the directors are distracted or not able to fulfill their duties or disconnected. We saw this week that Chairman Atkins also acknowledged the pain of this broad brush approach during his remarks at the New York Stock Exchange regarding materiality and also the thresholds to which we hold investors for determining regulations. So we've also started to see that this approach, this monolithic approach, may not be working from a regulatory perspective as well. We've also found that shareholder proposals have reflected this monolithic approach, but in a slightly different way, where in addition to the considerations that Brad mentioned on the sometimes scattershot approach to topics, it's also true that shareholder proposals do not necessarily reflect the market, but a predisposition to focusing on large brand name companies. A handful of companies receive a disproportionate number of proposals, with the irony being that these companies often have what investors and proxy advisors consider to be best practices with respect to governance. Many of the proposals that companies receive are one of dozens of the same proposal that are sent to companies, further painting them with this broad brush approach. And we've also found that companies have been receiving dialectically opposed proposals, which puts them and their investors in an odd position. And companies are further constrained when they try to seek out engagement from their investors, and their investors have been feeling constrained in their engagement practices after the 13DG guidance last winter. All of this points to the idea that it's time to really re-examine the approach to shareholder proposals.
Thank you very much. And our final speaker is Professor John Coates. He's a professor of law and economics and deputy dean of Harvard Law School, former general counsel and acting director for the Division of Corporation Finance for the SEC. Professor Coates, do you have any thoughts responding to the discussion so far?
Thanks, James, and thanks to the committee for the invitation. Very nice to see some old faces, and I remember fondly my time on the committee itself. So happy to help here as best I can. I'm going to make a few remarks about something that hasn't quite been framed in a sharp way, although a couple of the speakers have alluded to it, and that is there is beyond the SEC, but also on the SEC RegFlex agenda, the possibility of thinking about index funds and how they vote. This is a topic I've written about. I would encourage the advisory committee and then working with the commission to think about the following question. Are there rules or liability risks that the SEC could do something about with existing authority that would give the index funds or other large institutional owners more flexibility to think about how to engage with their own clients about voting? Right now, we have proposals that I think are remarkably stupid, like no voting. I don't believe at the end of the day, companies, I'm fairly sure the Business Roundtable would oppose that idea. I'm fairly sure that shareholders would not like that idea. And yet that's like a live topic. I think a lot more work could be done in between the extremes of the current system, where effectively the index funds vote, somewhere between 20 and 30% of all shares, according to governance staff at those fund complexes, and the opposite extreme of taking away their votes altogether. So they've begun to move on their own with their limited ability to do so under the existing legal system, to having some voting choice. But the voting choice is at a very aggregated level. It's sort of policy, and even then it's recommendations. And I think that's in part reflecting constraints they face that the SEC could do something about. So here's my vision. It's just my, personal vision of what seems plausible, but has not yet been tried, in part, I think, because of regulatory inhibitions. Most retail, to hear Jim's point, can't keep track of all the companies they own. We want them to diversify, so we don't want them to only own a few companies. We want them to own a lot of companies, but that means it's very challenging to keep track of all the votes that come up at all those companies. So the index fund providers have an even worse problem because they're investing thousands of companies on behalf of millions of investors. So we need some way to reduce the complexity. And I hear that one size fits all is a bad idea from the prior speaker, but actually we do need to reduce the dimensionality of the problem, because otherwise retail will continue to not participate, and the retail who invest through index funds will continue to be left out. So is there a way, for example, to survey retail, both direct retail and through index fund retail, about what they care about? And then take those survey responses and use it to pick a small number of issues, and then actually pass through votes, even through the index funds, on those issues. And that could be a changing list over time, reflecting different sentiments, et cetera. That sounds like modestly complicated. It would be enormously complicated to pull off. I'm grossly understating the challenge associated with that. But that, to me, seems like a vision that's not at either of the remarkably dumb ends of the spectrum that people seem to be going back and forth between. All right, that's on index funds. I want to pivot to shareholder proposals, say a word about that, and then I'll stop. So precatory proposals have been most influential on core governance, classified boards, majority voting, this year's special meetings. That's a really important channel to preserve the ability of shareholders to communicate with boards about a core topic that is absolutely at the heart of traditional corporate governance. The SEC's recent moves, to me, seem unduly driven by the E and the S part of the equation, which is odd, actually, given that it appropriately may be thought of as more partisan and more political. So let's focus on the G, but the current approach, which is not providing action relief, covers everything. And I don't think that's actually an equilibrium outcome. I think companies want the ability to get some guidance about novel proposals, and investors are going to want to continue to not be forced into mandatory bylaw proposals as the only path for getting their votes into the proxy statement. I will also allude to the Delaware point, where I must say, I find this all quite quixotic. Leo Strine actually said, Delaware is fine with precatory. Pender's argument, who's the person Atkins cites, did not say it's improper. He said it's just not mandated. And in fact, Atkins' own speech, it's interesting, in a footnote, which many people have not noticed, and I think that's not a coincidence, it was in a footnote. He says, Frank Bellotti, one of the leading experts in Delaware, so he's praising Bellotti, said flatly, precatory is authorized by Delaware statutory law. And if you think about First Amendment, right, what 1488 on precatory is doing is providing a structured way to speak. If you took it away, the First Amendment would guarantee it would continue, but in a less structured way, and in a way that I'm not sure boards would actually really appreciate in the long run. The thresholds issue, Jim's worried about raising them, I get it. I think there are ways to experiment with trying to limit, and I take the point that, if you stare at a major company, there's often, frankly, just too many in their one proxy. They become magnets for everyone. I think there could be appropriate issuer by issuer limits. I think there could be limits on, kind of prioritizing among different potential proponents for any given company in any given year. So I think there are things that the SEC could do to try to address. But I'll just note, contrary to popular impression, the number of proposals this year is down 25%. And of the ones that actually were voted on, a significant number got majority votes, and an even bigger number got 30% votes. In fact, the average vote on those voted on was 25%. So do boards not care what 25% of their shareholders think about important topical issues? I think the answer is, of course they care. And if you take away this channel, I think you're just going to end up with that energy flowing in directions that is less good. The only thing I'll say about proxy advisors is to repeat, First Amendment, good luck getting around that, guys. I think there's no way to do the executive order that's been floated. It would clearly be unconstitutional. It doesn't stop this administration. They do all kinds of unconstitutional things, so it may very well come out. But in any event, don't count on that actually mattering at the end of the day. Finally, in arbitration, I really do think issuers would be worse off with class arbitration than with class action. Class actions, because they lead to a trial and potential public, there's a whole apparatus set up in PSLRA, et cetera, designed to weed out bad claims. And that happens. And I know issuers think there's still weak claims that are brought and they get too far into the process. But you go into arbitration where you don't have those procedural ways to get rid of cases, and you have an arbitrator whose tendency is to split the difference on close questions, I actually think the expected losses for companies on weak claims would go up. Now, the alternative may be, well, we just don't have classes. We don't have class actions of any kind anymore. And that would be a dramatic reduction of the ability of investors to protect their rights. And unlike the consumer contract context, where most of us are never going to bargain with AT&T over our arbitration clause, investors will change the cost of capital if you take away their ability to sue for fraud, which is what would happen if you got rid of class actions altogether. The cost of capital would go up just as it has in every other country, which is why, by the way, notwithstanding Atkins' views on this topic, thousands of companies come here and voluntarily list and take on 10b5 liability risk. Why? Because the trade-off, lower cost of capital in return for some pesky litigation now and then, is worth it to them. And I just think fundamentally the idea of moving to arbitration across the board, again, like some of these other ideas, is not in equilibrium. It's just not going to ultimately work. I'll subside there.
Thank you very much, Professor Coates. Now we will go to each of the issues, but I think we need to tackle one larger item, and that is, does corporate governance matter? I think earlier during the meeting, there's a suggestion, basically, share owners not knowing enough about what's going on with the company, being pesky, not focused on material issues, not supporting what a company wants. But from an historical perspective, and I would like to turn to Nell first, does corporate governance matters within that, discuss, proxy voting and shareholder proposals and then with regard to corporate governance. Can I hear from you, Nell?
Yeah, thank you, James. I always say that capitalism is named after the providers of capital. That's the shareholders, and the entire concept of capitalism is based on reducing agency costs. If I want to invest in a company and they say, just trust me to provide you with the information you need, trust me to put people on my board that are good, that's not good enough. And that's why we have these rules, because they reduce risk. I like to say that when I first got into this business, O.J. Simpson was on 5 boards. He was on an audit committee. The other guy in the audit committee wasn't famous, but he didn't know anything more about auditing or accounting than O.J. Simpson. And I think today we would see that as a risk factor. Why would the CEO want to put O.J. Simpson on an audit committee? It would not be because he wanted to have a rigorous, independent committee looking at his numbers. So we've seen over and over again that it is the accountability to shareholders, it is the accountability through litigation, through proxy voting, through proxy contests, that to an extent limits the agency costs. And a key element, I'll just say one more key element of that. When I was in our previous company, originally called the Corporate Library and then changed the name to GMI Ratings, we rated boards of directors like bonds, AAA to junk. I think they still do that. And I could tell you all the various factors that we used, and they were all really good factors. but they were all based on their decisions. We didn't give points for putting their corporate governance policies on their website. I don't care about that. We looked at their decisions, and particularly the decisions where there's a conflict of interest between the shareholders and the managers, starting with executive compensation. The managers want less variability. The shareholders want more variability. And what we found is that boards of directors that can't say no to the CEO on pay plans produce poorer results for shareholders. And that proves that governance matters.
Thank you very much. And what are your thoughts, Brad? Brad, the sound?
Sorry, couldn't have any more technical difficulties, I don't think. So hopefully this will be the last one. Yeah, absolutely, governance matters. And you know, as I said before, I think from the issuer side of things and talking with clients on my end, you know, it's not, they are focused on governance. They want to hear from investors. They want good governance. But the shareholder proposal process, you know, is inundated with non-governance proposals and special interest issues that really actually muddy the whole landscape and distract management and the board from the, you know, what they should be focusing on, which is running the business and key corporate governance issues. I also think, you know, some of the even key governance measures, while I think important, you know, you still see most IPO companies going out with classified boards, not having special meeting rights, things of that nature. And if the investors truly thought that that had a economic impact on the company, you would see that in the pricing of the IPOs and in the trading of those stocks post-IPO. And so there has, you know, at least to date, not been a real impact from that. And that's why you still see those companies go out and the commonality of those provisions. And also, obviously, for a newly public company, those protections are important in many cases. But we, like I said, we have many companies that a few years after an IPO, they're not on the shareholder proposal radar yet, but will proactively look at their governance structure and make changes. So, you know, from my perspective, it's more about the way that the 14AA process has been co-opted. That's the issue, and also the impact of proxy advisory firms, and now mentioned agency problems. But I would say that the proxy advisory firms themselves have an agency problem. They don't have any economic stake in the companies that they're advising and making recommendations on. And I think that is a fundamental problem.
And Jim,
sorry, James, I just have to respond to that. It's great to see lawyers doing their job representing their clients, but you've got to, you know, give me a break. If they did have an economic stake in the company, you'd say that they had a conflict of interest. You know, I have a separate job as a movie critic. I don't have an economic stake in how the movies do, and that's what makes my criticism valuable. That is absolutely ridiculous. And in terms of deciding whether an environmental proposal or a social proposal about human trafficking or slave labor is relevant, I would leave that to the shareholders. I really don't think the issuers are in the best position to decide whether that's of interest.
But should the company's proxy statement be co-opted by those proposals?
They're not co-opted. They're not co-opted. It is the right of the shareholder to express those views and allow other shareholders to decide whether it's something that they want to
raise issues at a meeting. The question is, do they have the right to put these proposals in the company's proxy statement? And that
is actually part of the essential agreement that we have to allow for that kind of independent oversight. So you got somebody like Jim McRitchie, God bless him, who is out there putting these proposals on the proxy and getting support from a very wide and varied range of shareholders. And I think that is an important way and a very cost-effective way of communicating with management.
Certainly, I don't argue against the fact that corporate governance proposals tend to do well, but I think earlier there was a statement about proposals getting 30–40% of the vote. And that's absolutely not true of environmental and social proposals. They do very poorly. So I question the value that we're getting from them. I don't
Brad, sorry, that was me. So that was the 25% average vote as reported by Gibson Dunn, not exactly an anti-issue or source. And the 25% includes E&S. Now, it is true that on average, governance gets a higher vote, but there are certain E&S proposals that over time have gotten majority votes, and they certainly get more than 25. Many don't, and the current rules allow issuers to kick them out if they don't get a good enough vote, right? And you could tinker with those revote thresholds, right? Fair point. If they get 0.1% sustainably, they shouldn't be in the proxy. But that's not the system we have right now. They actually have to meet specified thresholds year after year in order to be brought back.
So we're going to some interesting things. And so basically, I'd like to go to the issue directly with regard to whether or not E&S proposals have any value. And I can actually cite a few that can opine on to see whether they have a value. In 1948, there was a proposal against Greyhound because Greyhound was enforcing segregation laws. We all, it's taught in law school, the Cracker Barrel shareholder proposal, where Cracker Barrel basically would not hire and would fire anyone who was gay. And you also had the proposals against napalm. And so now the question becomes, each of these would be considered in this E&S gambit. And the question is, do such proposals within an economic environment where we are focused on financial materiality have any value?
Well, I would like to say that, I want to jump in on this conversation that we've been having. When I started out, I said to my friends and people that I was working with that, we should focus on corporate governance. That's, if you can get the right board of directors, then you don't have to worry about all this other stuff. But as time went on, and I saw that, there's proposals on subprime loans and, aimed at banks that were making subprime loans. And that was before the debacle. There was all kinds of proposals on political spending. I mean, on Citizens United, when Kennedy wrote his decision, he thought that political spending was mandated. You had to report it. It wasn't mandated. We've been going company by company to get them to report their political spending. So I think these issues are very important. And so now I'm working hand in hand. I'm a member of the, get the group right now, it slips my mind. ICCR, yeah. So, and lots of other groups that I work with. And so I think, we have to work together, and it's not going to be just directors. That's still going to be my major focus on corporate governance, but I still do file political spending. I file lots of other types of proposal as well. And I'd say about 25 to 30% of the time, I get an agreement that we don't go to the ballot. And I can say the same thing for As You Sow and other organizations that I work with. A lot of these shareholder proposals you never even see because we get agreements with companies. Most companies are happy to sit down and dialogue. Some companies I found are not happy to sit down and dialogue. And the one company where I actually filed the 13D and was going to go after the company, once I got into it, I found out there was so much illegal stuff going on at that company that, I just got out of it right away. It's like, okay, this is not a good idea. So I'll give the floor to somebody else for a minute. Thank you.
Thank you, Jim. If I may maybe jump in, it's a bit hard to answer the question, are E&S proposals relevant, or it depends. It depends. And each investor has their own approach to decide how to vote on a shareholder resolution. But across the markets, it's clear that resolutions that obtain significant shareholder support tend to be those that are not overly prescriptive, don't try to micromanage the company, and that concern issues that investors deem financially material. And that can be an E and S issue. For some sectors, for some companies, these issues can be financially material for the success of the company. And so shareholders tend to support proposals that can catalyze improvement in governance, and that's the proposal get majority, the most support, but also in reporting, in risk management, and in this long-term strategic thinking that we want the board to keep also that long-term horizon and focus as well. And I think shareholder proposals can be extremely effective at doing that. And investors can also share their input with the companies and their views and experience. So companies can also learn from investors.
I just want to raise, James, I note that you picked some really interesting shareholder proposals and they are historical, but you didn't pick ones from the last 3 or 5 years when companies have had hundreds of proposals. And I think one of the issues with social and environmental proposals is, one, there's a proportionality and a cost. So for the handful of ones that are important, one, do you need it to be via shareholder proposal, or are there other ways to talk to the companies, bring issues to their attention that are not the shareholder proposal process? Because you're talking about a handful of proposals that get majority support at the cost of hundreds of proposals that get anemic support each year, but have really significant costs for companies that you don't necessarily see, that may or may not be in shareholders' best interest to have companies dealing with dozens of proposals. But the other issue that we have on environmental and social proposals is that they tend to be trendy. And we tend to ask companies to make really significant governance changes via shareholder proposal process when the winds may change in 2 years. And if you take the DEI proposals that were receiving majority support only a couple years ago, and last year got really minuscule support, I'm not sure how a company is supposed to interpret that. If on 1 year a proposal gets 30%, so we're in a realm where, yes, it can be resubmitted, it's an important issue, maybe you go and you do shareholder outreach, the same proposal comes back the next year, and now you're at 5%. And so if you're going from 30 to 5% on issues, is it that the issue is no longer important or material to the company? Is it that the company has turned around what they've done in the last year? I don't think so. I think it's signaling trends and macro winds that are pushing investors to vote not based on financial materiality, but based on their interests.
I think that's a good point. And it's also, I think the proxy advisory firms amplified some of this, because if you look at the numbers, they almost, unanimously, vote for left-leaning E&S proposals and against right-leaning proposals. And so, again, there's a politicization of the proxy advisory firms at play here with respect to these proposals.
So, is supporting adding women to boards something that's left-leaning, or it's something that everyone can embrace?
Very good question, James.
And James, I would add, and maybe I'm European here, so, for me, if I think of the physical risks of climate change that have been quite evident in some parts of the United States, this I cannot see as a political issue. I don't manage to see how this is left-leaning or right-leaning, but I admit that I am European.
So James, sorry, let me comment real quickly on something that, do you mind, James? On that question. At one point in time, a resolution relating to gender diversity on boards would have received relatively low votes. And over time, it would have gotten an increasingly large number of votes. And then you get to 2017, when State Street announced they would track companies, and if they didn't get to 30% with a certain number of years, they would start voting against the NomGov chair. And then through that process, the number of women on boards went up and went up and went up and kept going up. All right, now we come to the point that Liz was making. Well, like at some point, you wouldn't expect it to go up forever, right? There's going to be some point at which that ceases to attract as much attention. And so you're probably going to see some reversal to the mean, and State Street probably in line with worrying about the current administration drop their gender approach in March of this year. And does that mean that they no longer care about women on boards? I don't think so. It's the same people. And if we went from 30% back down to 5% next week, I expect they would be reinvigorated in their concern for this. So some of the ebb and flow that you're talking about, Lisa, is rational. It's, you know, there's a goal to be achieved. Environmental reporting was not something that big companies did 25 years ago. All the big companies almost do it voluntarily now. So there's no more need for shareholder proposals on that topic. So you're going to see a fall off in support for that kind of proposal. And last thing I'll say, I'm with you on there's too many for certain kinds of issuers. I already said that. I want to repeat it. I think, but I don't think the blunt instrument of throwing them all out, which is what's actually on the table right now, is a good way to respond to that, right? You said there are other ways for shareholders to engage with boards. There really aren't for most dispersed shareholders. Even ones who own substantial portions of the shares are not going to call up 4,000 companies, right? The structured process of the proxy statement provides a shareholder-funded, by the way, we call it the company proxy statement, but it's actually paid for by the shareholders, a shareholder-funded process for limiting the amount of communication to a small number of issues. And somebody's got to play gatekeeper in that. And if you don't have a gatekeeper, then, right, I'm done. Sorry, James, I'm going on.
No, yeah, I would just say that there is a way for them to get access to the meeting and bring their proposal, and that's through soliciting their own proposal and their own proxy statement, which, by the way, does not cost that much money to do.
Actually, I've done it. It costs a lot of money, and you have to have lawyers, and of course, almost all votes are cast ahead of the meeting. So I've done all of that. So that is actually not true. And with regard to the environmental, again, the SEC has limits on what can be in a shareholder proposal. And now we're on the honor system. So companies can just say, we've decided that this is outside the limits of 14A8. It's asking us to do things with the environment that are beyond our capacity. So we're going to exclude it. And importantly, the SEC has said, we're not going to question your assessment of the applicability of our rules. It could be absolutely central to your business, but you're telling us it isn't, so that's fine with us. You go ahead and exclude it. Remember that the vast majority of public companies get no shareholder proposals. And it is true that if you are going to be a major household name, if you're going to be on television all the time, like Elon Musk, you're going to attract more proposals. That's the cost of doing business. But they can still exclude anything that's not directly related. And as for DEI, I can certainly understand how, as a shareholder, you might have a different assessment of a DEI proposal in the Biden administration and the Trump administration when they are hitting companies hard that have DEI. So, you know, there's nothing wrong with reflecting what's going on in the world. I think it's a huge mistake to characterize proposals you don't like as political. I think every proposal that I have seen actually make it onto a proxy has got material economic interest at stake.
Let me just interrupt here. One thing, I've been sued several times by companies. Instead of going through the no action process, companies can go directly to court, as Exxon did a few years ago, and there was a lot of news about that. Well, I've been sued maybe 4 times by companies, and companies will bring a dozen attorneys to their side of the table, and they'll tell me over the phone, when we win this lawsuit, we're going to recover our legal costs. We're going to recover our court costs, and you won't have a house to live in anymore. Well, I lost one of those lawsuits, and that was in Texas, but I won the other 3. And and I represented myself, and I'm not an attorney. So, this is, do companies really want this kind of process instead of going through the SEC's no action process? I don't think so. I don't think most companies want that.
Thank you all very much. This has been an enlightening discussion. And what I get from it is that the shareholder process is in fact important, but we all want quality proposals. And kind of in line with what Commissioner Peirce was saying, but with regard to shareholder proposals, is that we could in fact be a little more focused, but it's critically important that the shareholder proposal process remain. Let's turn to the ExxonMobil no action letter, and I'm going to turn to Brad to begin this discussion, where the no action letter allows ExxonMobil to set up a retail voting program. And so I would like to get Brad's thoughts on this, and then I'll turn to Jim. Brad?
Yeah, I mean, I guess it's not going to surprise anyone what my thoughts are, and wrote an article about this. But again, and I think people might be surprised by what my own political leanings are. But in my view, I really have a hard time understanding the criticism of this. There's the activists, the special interest proponents that are up in arms about the program. I don't think it's hard to see why that is. And it's because they benefit currently from the apathy of retail investors who don't vote. It helps them if they don't vote. They're scared of a retail vote. Why is that? Because retail voting tends to vote with management. And so anything that's going to prop up the management vote is a threat to their objectives. But the idea that we don't want more retail voting is just completely baffles me when everyone is talking about enfranchising shareholders. This is enfranchising shareholders. It's not locking in anybody's vote. They have the ability to change their vote at any time. They get an annual update every year of what their selection was. They still get the proxy materials. And so you're talking about a group of shareholders that largely don't vote, now giving them an upfront vote and making it easier so that they don't have to keep voting every year. I really don't see what the all of the concern is about it, to be honest.
Well, the concern is, if you're going to vote with management all the time, okay, now you have a process that you want. But the concern is, many of us, basically there's not one company that I own where I always think that management is always right. Management is not always right at any of the companies. They may be right,
but nothing prevents you from...
And I should have the right to be able to vote through voter information program, where I can say, okay, here's my priorities the same way that institutional investors can, and have my votes voted automatically. And that's what I do right now using Iconic, but there's other platforms where you can do that.
James, would you mind if I...
favor of what the program is?
Yeah. Yes, Brian?
James, I'd like to exercise the prerogative of the chair to jump in here and ask a question of James and Brad. Let's assume that there is something that is happening here, which is, in fact, that we are increasing retail participation. Let's take that as a given. But taking a cue from what James just said, but what is happening, though, right, is that you have a program which is then defaulting, in effect, to management. And yes, there are ways that, obviously the shareholder proposal, the 1488, the relief that the SEC granted was based on the fact that there are ways of revoking that, and you have to go back, and give shareholders an opportunity to that. But putting that aside for a second, what if you broaden this? What if you broaden this ability of shareholders to cast, their decision in advance? What if you broadened it so that instead of just saying that management has the opportunity to solicit that that proxy, that in fact that you could grant that other folks could do the same thing, right? That you could broaden it so that is, I think Jim is proposed in his materials that he sent around, in fact, that you do have the right to grant that same proxy or that same voter information right. You can give that to a third party. And whether that third party is Jim or whether that third party is, is John Coates or whoever it happens to be, to the proxy, some service. But instead of just allowing it to go to default to management, what if you broadened it? Because therefore you are broadening retail participation and you're not just defaulting it to the management slate.
Yeah, that's what I'm proposing is standing voting instructions. But I'm not saying that I'm going to give my vote. I'm not giving it to someone who's soliciting my vote. I'm asking for something like ISS and Glass Lewis. I mean, there are other platforms available that are less expensive than those that can help me vote my shares based on my voting policy that I've decided. So they're not soliciting the vote, but I'm using them. I'm voting through them. And this has become increasingly important to me after I sued Meta. I sued Meta platforms thinking that, okay, people that own Meta platforms also own lots of other shares in other companies, mostly because they invest through 401k plans and they're broadly diversified. And if Meta is doing something that's hurting the whole economy except helping Meta itself, then that should be something that the board should take into consideration. Well, the judge in Delaware is a good judge, but he basically came out and said, well, the board owes a fiduciary duty to the company and to the shares. And he said that the shareholders were incidental. Okay, well, if the shareholders, I don't think the shareholders should be incidental. I think the shareholders should be the prime. That's what fiduciary duty was designed to protect. So if fiduciary duty is going that way, then it's all the more important for me to be able to vote as an individual. So if I have shares in a company, I'd like Vanguard to pass them through to me so I can vote them, because if that's fiduciary duty, I don't want them voting for me.
But Brett, what do you think about broadening the rights so that it's not just a management default?
I mean, it sounds like you're talking about basically a version of pass-through voting, which the institutional investors are already putting in place.
But for retail, obviously this is on the retail side.
Yeah, I mean, I don't.
To be clear, none of the index funds are passing through to retail, just so we're clear.
Yeah. I mean, I guess I go back to the fundamental question of what of the issue then with the retail program now. I mean, it's one thing to iterate on it and say to expand it. That to me means that then we don't have a fundamental issue with the current program. Otherwise, so I don't, to criticize something by saying we should expand it, I don't think for something that is new in the first instance, I don't think necessarily means that the initial program is problematic. To me, that means we find value in it and we're looking to expand it.
Oh, the initial program is definitely problematic because it doesn't offer these alternatives. If they wrote to the retail shareholders and said, we'd like to have more participation from the retail shareholders, here are some options for you. You can use Iconic, which I also use sometimes when I'm not voting my own, or you can use the CalPERS policies, or you can use, or we will vote them for you. Then I would feel like it was fair, but just to only have, as I said, you cannot be the umpire and the pitcher and the batter at the same game. And that's what this is doing. So it's fixing it. It's not saying it's not problematic. It's proposing a fix to it, not expanding it.
For an individual company, the people most likely to own a significant number of retail shares would in fact be the employees. Is there any concern that such a retail voting program would be voting employee shares in a manner that they may not like, and it's forced because for some reasons they have to participate in the program, but they may want to vote differently when when it is in fact time. So is there any concern that this program impacts employees that are voting shares?
I think it's a very good point, James. It's certainly going to matter more at some companies than others. I will refer back to the 80s and the takeover waves when employee-funded trusts were created that were controlled by management as a way to, frankly, entrench management. And that was not viewed as consistent with good governance to have a bunch of shares put into a trust, the voting of that turned over to management nominally on behalf of employees. And so I think for existing 401k and other similar holders to be defaulted into such a thing would certainly be a problem. And I'll also just note, the current Exxon program is the subject of litigation, and the SEC's position on it, to me, at least raises additional questions about whether it followed the APA when it took the position it did. And so while that lawsuit has not yet been brought, I'm betting it will.
So I'd like to move on to a different topic, and I would like to get Elizabeth and Severin involved in this particular one, and it involves engagement. And so, interestingly enough, that many of the large institutional investors do not do shareholder proposals. Of course, they vote on them, but they do not initiate shareholder proposals. But they do engage with companies. So, Elizabeth, I'd like you to share in terms of your thoughts on the current state of engagement with investors and how has things changed in 2025 and what are the prospects for the future? And then I'll get Severin to comment on her thoughts on this as well.
Sure. And I'll start by addressing what you opened with, which is saying that large institutional investors don't do shareholder proposals. They haven't really needed to. If you can change your proxy voting guidelines to say, if you don't have enough women on boards, we will take our 10% block and vote against your directors, there's no need to do a precatory proposal. You've put in an enforcement mechanism that will change the operations and the governance of a company without putting it to all shareholders. So that is a very different world that large institutional shareholders live in. But what we've seen since the February 13DG guidance is that shareholder engagement has become more constrained. And I don't think that it's served companies, but it also has not served investors. And investors will say that they have, through careful consideration of the rules, generally been able to restart their programs, their engagement programs, and get enough of what they need from companies. But they will acknowledge that what they give to companies, the information that they pass along that may be important for companies in considering their own changes, the kinds of changes that Brad and I were talking about when companies make their own governance changes and evaluate their existing governance and systems, that has really been lacking. And the engagements have changed significantly. They're more muted, they're more coded, they are more difficult for companies to get information from investors. And what we've also seen, and we've been approached by a number of investors who will never file a 13D or even a 13G, who are nervous that one day they may change their stripes and be eligible to file 13Ds and Gs, is that they're also changing their engagement. So it's having a chilling effect even for investors who are not otherwise subject to the 13DG framework. And that, I think, has hurt the entire ecosystem because there are companies that really do seek engagement with their shareholders, with a wide range of their shareholders. They run engagement programs where they look to have engagement with more than 50% of their shareholders on an annual basis. But if they're not getting the information that they need in order to bring back to the boards of directors, in order to process that information, that's a really difficult environment that, in my view, has moved us back at least a decade in shareholder engagement.
Severine?
Yes, I can really agree with Lee's statements. So the value, the quality of the discussions has been really impacted. At first, there was this chilling effect where many investors didn't dare to even meet with the companies. That didn't last very long. So investors and companies are having a dialogue, but it has the type of conversation has really changed. Surrounded by lawyers and disclaimers and things we don't dare to discuss. So I think companies get much less benefit from this conversation, and investors as well. So it has put. But I think it was probably not the. It was probably an unintended consequences. But the SEC should clarify that as soon as possible to fix the problem.
Thank you much. I will ask one more question and then I'll open it up to the IAC committee members to ask questions of the panelists. In this final questions, I'm going to turn to Professor Coates. You served as general counsel of the SEC. Do any of the topics under discussion raise legal issues for the agency that the advisory committee might want to consider?
Thanks, James. Yes, I think there is a perfectly understandable impulse on the part of anyone running the agency, and I vividly remember this myself, to try to avoid the rulemaking process if you can find a way to do that and still have an influence on the world in a way that you think is good. Because the rulemaking process has become, in my view, unduly burdensome and unduly litigious. And with the federal courts being incredibly partisan, with the entire First Circuit consisting of Democrat-appointed judges and the entire Fifth Circuit, well, not entire, but most of the Fifth Circuit and the 11th Circuit going the other way, you have a highly likely partisan overlay at the end of the regulatory process. So I say all that because I just want to empathize with the current administration's use of no action relief, informal guidance, sub-rulemaking processes. But the thing I want to just highlight, and I already adverted to this on the Exxon thing, is some things that look like they're not rulemaking actually will be rulemaking if challenged in court. And so on each of these categories that we're talking about, how to deal with proxy advisors, how to deal with 14A8. 14A8, for example, there is a rule. You can look at the text. The text on the sub 1 exclusion is, not a proper subject. It doesn't say explicitly authorized by state law. It says not proper. For the agency to take an opinion that just says, well, not authorized, which is what the one Delaware lawyer has published a piece about, and then flip that into that's improper and therefore it can be excluded, I think would be subject to challenge under either the APA or for rewriting 1488 without going through a rule writing process, or just a blatant misinterpretation of 1488. And everybody should remember now, Chevron no longer exists, and so the courts will not defer to the agency's interpretation of its own rule. And I think you're going to find more Delaware lawyers who would think, as Frank Bellotti does, non-binding proposals have been legitimate for 75 years. They're not suddenly overnight illegitimate just because one Delaware lawyer says the contrary. And so if the SEC were then to use such a single opinion to keep out precatory resolutions without going through rulemaking, I think they would lose. So that's an example. And I could go through the other categories. The Exxon one, no action relief. It's kind of no action relief, but it's also reinterpreting the statute in a way that I don't actually think is likely to be sustained. And at a minimum, I would think the public, which is what the APA is designed to protect the interest of, would have an interest in how fundamental parts of the proxy rules are understood to mean. And so to do that through no action relief is certainly pushing the envelope. And I could go through the other ones in all of those. And let me just, the last thing I'll say, it's very interesting. People haven't picked up on in Atkins's, or actually the commission's explanation on the 14.8 piece. the first thing they say, and I think they're telling the truth here, is we're stopping giving guidance because we don't have the staff to do it. We don't have the staff to do registration statement review in Corp Fin. And of course, that's a self-inflicted wound from the past 11 months of chaos in DC, with massive turnover and DOJ running amok through bureaucratic agencies and people being paid to retire. So like, but if that's the motive, if the explanation for why we're not doing something that we're legally required to do is we don't have staff because they've all been encouraged to leave, I don't think that's a helpful fact in any of the litigations that are likely to follow from this. Again, I'm totally sympathetic to how hard it is to hire people in Washington. I think that part of the overall government process should be improved. We should be able to hire people more rapidly than we currently can. But you know, to say we don't have enough people, so we're not going to do the job we've been doing for 75 years, I don't know. That to me seems like a risk.
Thank you much, Professor Coates. We will now turn to the IAC members for questions. First up, I'm going to ask Paul Roy to ask a question.
All right. Thank you, James, and thank you to our panelists. Great discussion. Appreciate your insights. I guess this is sort of maybe a follow-on to Professor Coates' statements about process. And I guess what I'm thinking about is how the Exxon no action letter might be extended out. I think a lot of people are writing that other public companies may copy it, but I'm thinking about other contexts like mutual funds, closed-end funds, where they have difficulty getting retail investors in those funds to participate in the shareholder voting process. And it seems to me that I could see mutual fund companies wanting to go with standing voting programs and to facilitate retail shareholder voting. But when you think about the kinds of issues that can come up in that mutual fund, closed-end fund context, I'm thinking about situations where an investor may have given standing voting instructions to go with management, but then management is proposing an increase in advisory fees. So, you know, in that context, sure, there'd be a different set of guardrails or protections to make sure that investors aren't being overreached in these kind of contexts. So it's probably a question that you probably haven't thought about. I know, Professor Coates, you've written about, you know, subjects in the mutual fund area, but it just seems to me that from a process standpoint, when you start looking at how these programs may be extended, it might be better to, rather than proceed through no action letter, but through a notice and comment process.
So I agree with that, Paul. I think, and I also think you're right to pick out the fund world as a distinct thing, because the governance issues are distinct, and you don't have some of the same kinds of problems that the other panelists were raising about 1488. But you do have a question that still persists about how to think about rational apathy. I mean, people rationally choosing to not pay attention to how their voting rights are being used. I think that gets very stark in some closed-end fund moments. It's a hard problem because I agree with some of the other folks on this panel that simply assuming they'll always go along with management as a default, to me, seems problematic. But then how do you frame the alternatives or motivate enough of them to participate to actually get a sense of where they are without a full-blown proxy fight, which is, as Nell said, actually quite expensive relative to the typical investment of a typical investor. So I think rulemaking is right. I wish the rulemaking were easier. That is, I wish the process didn't take so long and didn't have so much litigation at the end of it, but I'm not sure the SEC itself can do much about that right now. It just has to be prepared to devote the resources if it thinks these issues are important enough.
Yeah, I'll just say that the investment advisors were specifically carved out of the no action letter.
I'd just like to address Paul's concern. So in standing voting instructions that I've put forward with the guardrails, if the instructions you've given now need to be overridden, you can do that. You know, if you disagree with what you said before because now something else has happened, then you can override. So
Thank you.
I'd like to turn to James Copeland for a question.
Sorry. Thank you. Yeah, I want to ask sort of James McRitchie the question here, sort of philosophically. You said you own shares in a few hundred different companies, and I know you coordinate with John Chevedden and certain other of these sort of like-minded investors, as well as some of these social investors. What I hear you saying is, not having a ton of money invested in the company, ought to be taken into account. And in fact, these ownership thresholds may even be too high as they are. And I wonder philosophically why that is. I mean, if I and my wife wanted to get a plebiscite on the ballot on a federal election, should we be able to do it? Because I mean, this is you're implicitly saying, I mean, because I don't know how much you own in all of these companies. Sometimes they're reported. It hasn't tended to be a huge amount, and it's if you're doing that with a company the size of an Apple or a company the size of an Oracle, aren't you really just the equivalent of like one guy on the street being able to get a shareholder proposal on the ballot? Of these companies, the equivalent of getting a plebiscite referendum on the federal ballot in a national election. I mean, what is the rationale for that, aside from the fact that you think you're right and you want to get your proposals on?
Well, the rationale is that there are lots of people out there with good ideas, and they should be able to put them forward to companies. And, we're also limited by a number of SEC rules with regard to applicability. So there are hurdles that you have to go through. And then once you get on the ballot, there's threshold that you have to get to if you want to come back again. So I think the system's been working. And the system, if you look, originally it was the Gilbert brothers, or back in the 40s and 50s, that were getting proposals passed. Without their work, we wouldn't have independent members on boards. That was something that they wanted. We wouldn't have reports even of what happened at the annual meeting. We wouldn't have a vote on the auditor. That all came about through these gadfly investors that owned very little in the companies that they invested, but they owned enough and people agreed with them. They voted in favor of those types of issues, and where they didn't, companies adopted them. So it's not just the wealthy 1% that have good ideas. It's lots of people in this country, and that's what makes this country great.
Now, would you like to expand upon that comment, given your experience in the process?
Well, thank you, James. Yeah, as I said before, it's been that way since the beginning. We've had a handful of individuals who have submitted proposals, but we do have, as a protection, the resubmission thresholds, and therefore, and the very, very strictly limited subject matter. Therefore, I think it balances the interests very well.
Thank you much. Next, I'll turn to Brian for a question.
Thank you, James. John, I wanted to pick up on something that you referred to about amending existing rules. One way to increase retail participation across the board would be to amend the rules which now restrict your ability to reach out to investors unless you go through a financial intermediary. So take, for example, if there's a contested election and you have an engaged shareholder, an engaged investor who is engaged on social media, but there's no way for that investor to then, while they're engaged on social media, to actually cast their vote at that moment in time. They have to either go home and find the hard copy of the proxy statement that's been mailed to them, which they've already thrown out, or alternatively, they've got to log in or somehow electronically get their control number. And so I'm curious whether, there is a if you have any thoughts about the amendment of the existing rules, which require you go through a Broadridge or some other financial intermediary in order to be able to get access, whether it's the company or the activist investor. It doesn't really matter. Each side has their hands tied in their ability to reach out to retail.
Yeah, Brian, as you know, I've been kind of engaged with the overall topic of proxy plumbing for a long time. Since I was on the IAC, we wrote a recommendation about it a long time ago. And I do think that more progress could be made with some gentle or less than gentle encouragement from the SEC to the participants in the system to do things like eventually approaching the Spanish flat voting system, where, frankly, if I'm a retail and it's my shares, I should be able to go relatively easily through a couple of clicks and vote. And as you say, that's impossible right now. Technologically, it's not actually hard to map out how to do it. Institutionally, to get the cooperation from everyone in the system and whatever adjustments need to be made in the rule set, that's the difficulty. And of course, just as shareholders have rational apathy about any particular vote, most of the institutions in the process, including companies and law firms represented here, they don't really care that much about fixing the overall system. They've got things that are burning right now that tend to get in the way of that system reform. So that's why I think in the end, it's got to be an SEC-driven process, because it's a collective action problem. So yes, I agree with you.
Now, can you pick up on that? Because you mentioned also during your opening remarks that there should be a focus on the proxy voting system or proxy plumbing. What did you have in mind?
I think I just associate myself with Professor Coates' comments. I think he's absolutely right. I'm concerned also that Broadridge sells some of the data about the votes that is a result of essentially their monopoly. And technology has improved to the point where we really can do a lot better, a lot more efficiently without having them as the intermediary.
Thank you.
Thank you much. Next up is Andrea with a question.
Thanks, James, and thank you to all of the panelists. I have a question about mandatory arbitration and the shift on that particular issue. And so during Commissioner Peirce's opening remarks, she expressed the view that the SEC should not override the company's preference on this issue. If they prefer to have arbitration as their resolution process, that's what they should be able to do. So my questions, I have two related questions for anyone who's willing to speak on that. First is, do you guys anticipate that strong, profitable companies will exercise this new right to mandate arbitration for dispute resolution? I've heard that so far only one company has taken advantage of this. It's a oil and gas penny stock company that was delisted by NASDAQ in 2020, has no operating revenue, has suffered a lot of class action litigation, SEC investigations. So I can't understand why that company might prefer mandatory arbitration. So the first question is, do you anticipate strong, profitable companies are going to take advantage of that? And then my second question is, what about shareholders and their preference? Do you think shareholders have a view on whether arbitration should be mandated and that the commission should be overriding their preference? Thanks, James.
I think Brad
Yes,
wants to speak.
I'm happy to weigh in on the first question, but I think I do think that there are companies that would be interested in exploring it. I think the issue right now is that the Delaware Corporate Code doesn't allow for it, and so for most large public companies, many or most of which are incorporated in Delaware, it's just not actually an option. So I think until something is done on that front, you're not going to see any widespread adoption, and mostly because they can't do it. But I do think, from talking to clients, people certainly, I think, would be interested in it. And again, I don't I think there are probably pros and cons. I hear different things from different litigators. And so people will have to make those decisions for themselves. And over time, if there's a cost of capital issue, then that would, rear its head. But I don't think the assumption that all of these things are going to happen, it's hard to see how we can make those conclusions now.
I alluded to this earlier, but I think currently Delaware is not the only choice. You can go to the Caymans, you can list here, you can build into your Caymans organizational documents arbitration. So it's a live option and has been for the past 30 years. And I don't observe anybody doing it. Now,
Well, it wasn't an option under the existing guidance.
Well, actually, the current guidance applies to the IPO process, not to the cross-listing process. So, you could list in some other country and then cross-list. So again, people want exposure to our IPO market. And personally, I think the longstanding IPO protection was a good one, because I think the IPO moment is the most acute moment of vulnerability for investors. I think once the company's up and running, get secondary prices, you can rely on that to a significant extent to help protect people. But in the IPO, initial price formation, anti-fraud protection is fundamental to the statute. And if the effect of the arbitration is just to shift the basic process into a private sphere, but preserve class, then I actually think very few companies, if they're very well advised, would do it. But I think if you couple, this is what's key about this, is arbitration just arbitration, or is it eliminating class relief? And if that's true, then yeah, I could see some companies wanting that, but then yes, there would be a very, I think, significant risk to investors. And you're right, Brad, eventually the cost of capital point would sort itself out. And I actually don't think it would be sustainable, but I'm sure there are some companies that would try it.
Thank you much. Next question from Alvin.
Yeah, so I got to admit, I feel weird asking this question because I've asked it in other meetings, but we talk a lot about gadfly investors and their kind of pernicious effects on the shareholder resolution process. However, there seems to be a set of investors that are also putting forward politically motivated, or those that might seem politically motivated from the perspective of the company. And in this specific case, I'm thinking about institutional investors, such as both labor union pension funds, as well as sometimes people would accuse your certain state pension funds or state pension funds as pushing forward political agendas. My question is, are those type of institutional funds that have a fiduciary duty to a class of, in this case, workers and employees, are these considered gadflies? And I think specifically, I'm thinking, I would love to hear from the entire panel on the question, but I just want to make sure we're very precise about what we mean by a gadfly investor and an investor who has aligned interest and is not a gadfly. So I want to get some clarity on that. Thank you.
Well, I always say the thing that people forget about the gadfly is it does get the animal to move. And so I don't use that as a pejorative. I don't think there's anything wrong in that. As I keep saying, the issue is not the number of shares of the person submitting the proposal or asking for engagement. The issue is the level of support that they get. And I think it's been my experience as somebody who's read a lot of proxies that the institutions that you talk about do an excellent job, and I can send you some examples if you want, of tying the things that they're asking for to very specific financial quantitative issues of risk and return. So again, my view is put it to the shareholders. Mm-hmm. We've got a wonderful economy with all kinds of shareholders. We've got index funds. We have targeted funds. We have all kinds of different funds. And if you can get a majority vote from mm-hmm. that very, very heterogeneous group, then that tells you it's probably a financially relevant issue.
No, I would love to see those examples. I'll drop my email in the chat.
Okay.
Thank you so much. But others feel free to weigh in.
I tend to think a gadfly is somebody who I don't like, who doesn't have a huge amount of stock. So I normally don't tend to think of Gadfly as associated with a significant fund that is bringing a proposal, even if one could take a view that their motives for that are, not strictly narrowly understood financial in nature. Just as a quick riff on that, asbestos at one point in time was not financial. It was just a thing that companies chose to use or not. And then it got recognized as a risk, and then it became quite financial, and then it bankrupted whole industries. And so today's financial is not necessarily tomorrow's financial. And gadflies, if you want to call them that, sometimes spot those issues coming. Sometimes they're wrong, like to Nell's point, but sometimes they're right.
So we're going to move to the next question. Colleen?
So first of all, thank you so much to the panel. This has been really, really interesting, and I really do appreciate all of your time today. So I was actually hoping I could follow up. A number of you actually mentioned or suggested that there would be various unintended consequences if we were to have a significant reduction in the use of shareholder proposals. So Professor Coates, I think that you actually suggested these efforts would sort of pop out in other areas. I was hoping that the panel could speak a little bit more to some, potential unintended consequences that you think could occur.
I'll really quickly say the most straightforward thing is the same proponent who would, let's say, an expectation, think they're going to get 20, 30% of the vote, could call up 20 or 30% of the shareholders and say, I'm not calling about a solicitation. I'm just calling about an issue. And I want to go to the company and I want to tell them that you're behind me on this. And they do it. And now that would be unobservable. It would not be public. It would not go through the proxy statement. The management team would have less ability to anticipate and respond. Other shareholders wouldn't know. So I think that all comes with some real cost, but that's a channel. Another channel, and I'll stop, is if I were a major institutional shareholder and I lost the right to vote on precatory resolutions because of an SEC change relating to state law, I would rely on my state law rights, which are to adopt bylaws. And bylaws in Delaware can cover anything practically, and they could certainly they could reestablish the right of shareholders to bring precatory resolutions. I don't think there's any Delaware lawyer who would tell you a bylaw couldn't say that. And I think if there were sustained interest in this, as I think there would be among most institutions, then you just have a wave of bylaw requirements undoing the change, and we'd end up back to where we started.
Yes, Brad?
Yeah, I actually just published an article last night on what the landscape could look like in the absence of precatory proposals. I think John's right. We could see binding bylaw amendments to allow precatory proposals. I think we could see companies deciding on their own to adopt a bylaw proposal that allows precatory proposals, and some companies might decide that it should be a higher threshold than the current thresholds. I think you could see certainly more use of 14A4 and self-solicitations. There's all manner of ways I still think that people can get their issues across to the company without having access to the company's proxy statement, owning virtually no shares and having little economic stake.
Elizabeth?
One of the things that we have also identified is, and for the record, I don't want my statements to be misconstrued that we are anti-shareholder proposal. There is some rationality to be brought to the shareholder proposal process in our view. But if you take away shareholder proposals entirely, you could end up in a world that the prior commenters discussed. You could also have more impacts just on the annual meeting in the ordinary course. There is almost a hydraulic theory of shareholder engagement that occurs. And if you take away this avenue, what do you get in return? And so you could get lower votes on directors. You could really impact say-on pay, which is somewhat unintuitive, which is also precatory. But say-on pay has at times served as an other or canary in the coal mine vote in general on companies, rather than pick a particular person to vote against because you have to vote against a person, voting against say on pay has been a relatively easy way for investors to say, well, I'm not so thrilled about the company in general when you can't tie it necessarily to a compensation related issue. And so I think you put pressure on other mechanisms that already exist if you entirely take away shareholder proposals. But if we're talking about taking away shareholder proposals that are routinely getting between 0 and 10%, I don't think that you get those types of impacts. If you shut off the valve entirely, that's when you put pressure on the rest of the system.
Yes, Sabrina.
Thank you. Yeah, thank you. If I may jump in, this is interesting. We can't really predict what will happen, but we can try to guess. The current confusion and the uncertainty, I think the first stage will be perhaps more caution, as we've seen with engagement. I don't know if that's the goal, but more caution from investors. So investors will be more careful, hesitate before filing shareholder proposals, spending time and resources on this, the same way that they've been more guarded in their dialogue with companies. And what comes next, as I mentioned, is likely more tension between companies and their owners, which is really unfortunate. So if investors feel that they have important concerns, but they have fewer effective ways and constructive ways of raising them, they will find alternative ways to express their voice. And as Liz mentioned, that could be voting against the nomination of directors or other votes. But more broadly, and that's the real concern for investors, if you remove the systems of checks and balances, if you diminish that and you have less right as a shareholder, there is more risk that companies don't manage risk effectively, don't act in their shareholders' interest, and that ultimately the fear is loss of value for shareholders. So, opening the door to fraud, abuse with less safeguards in place. And so that's why I think there is a risk that investors may end up viewing the US market as a whole as much riskier. And that has a cost. So that can impact their capital allocation decisions over time. It can impact their valuation of US companies. And Professor Coates mentioned the cost of capital. I think that's really the risk and the unintended consequence, I imagine.
I think it's also important to point out that the fear that companies are just going to unilaterally exclude every proposal now because they don't need to put in a full-scale no action letter. I'm not seeing that. I'm sure Liz would tell you the same thing. I don't think that's actually going to be the result. I think companies, certainly the companies that I work with, they want to do the right thing by and large. And so they're not interested in just excluding proposals on their face that they know pass muster. And even the proposals where they may have put in a no action letter and felt they had a very strong argument, many companies now are reluctant actually to rely on the guidance and just put in the notice because they're afraid of getting sued. And so I think this concept that, everything has, the world has ended here and all shareholder proposals are going to be excluded, I think is unfounded. And I actually wouldn't be surprised if we see more shareholder proposals of the type that may have gone the no action letter route going in this year. And again, on the 14A1, Delaware opinion, we're not really seeing people at this point wanting to step up in front and get one of those.
James, I turn it over to you.
Thanks.
James, I turn it over to you for conclusion.
Thank you very much. I'm very happy we've had this time together, and I want to thank the panelists profusely. I appreciate you spending your time with us on this incredibly important topic. So we invite the audience to carry the conversation forward and urge the audience to review your own policies and practices in light of the changes and share concrete feedback with the SEC and the Investor Advisory Committee as the 2026 landscape takes shape. Again, thank you very much.
Thank you, James. That concludes our Q&A session on our panel for this morning. I'd like to thank James as our moderator and our panelists for their time, their contributions, and the active engagement we had during this call. We now turn to the chairman, Chairman Atkins, to offer his remarks to the committee.
Very good. Can you hear me?
Yes, we can, Mr. Chairman.
Super. Well, thank you very much, and good afternoon, ladies and gentlemen. It's a pleasure to join you all for the fourth and final Investor Advisory Committee meeting of 2025. Before I share a few reflections, I have to note that the views I express here today are my own as chairman and do not necessarily reflect those of the SEC as an institution or of my other fellow commissioners. So, of course, I also want to thank each of you for your time, expertise, and spirited commitment that you all have brought to the committee this year. Your work is essential. Our markets prosper when investors have confidence that our rules are fair, our processes are predictable, and our regulators are not smothering innovation out of fear. I convey and share in the agency's appreciation for your dedicated service and extend a very special thanks to Christina Martin-Fervita, who will conclude her tenure as investor advocate at the end of January. Our work at the SEC should always be responsive to the needs and interests of investors, and Christina has provided essential support in service of these objectives. So, Christina, we wish you every success in your future endeavors, and we thank you for the contributions that you have made to our agency and to investors as a whole. I'm also grateful for the valuable insights that we heard during this morning's panel discussion regarding regulatory changes in corporate governance. One of my top priorities as chairman is to make being a public company an attractive proposition for more firms, and I look forward to engaging in this important work over the coming months as we guide the SEC back to the bedrock fundamentals on which our mandate is based. The next panel, meanwhile, will focus on how the Commission can modernize our rules to enable our markets to move on-chain. Distributed ledger technology and the tokenization of financial assets, including securities, have the potential to transform our capital markets. Our financial markets have long been the envy of the world, and to ensure that they remain so, U.S. firms and U.S. investors must have the opportunity to leverage this technology as they lead the future of global capital markets. Today, our rules assume that securities are issued, traded, and managed through layers of intermediaries, which help to address risks like information symmetry, asymmetry, and operational friction. But as we consider the rise of public blockchains and tokenization, we must acknowledge that these technologies have the capacity to streamline not only trading, but the entire issuer-investor relationship. In other words, tokenization is not just about transforming how trades occur. It can also enable direct connectivity for proxy voting, dividend payments, and shareholder communications, thereby reducing the need for multiple intermediaries in those processes as well. As we modernize our rules, we must consider the full scope of these changes, both in how markets trade and in how security ownership is recorded and serviced. I welcome the IAC's assistance in helping us think through how to respond appropriately to these innovations. So, as with any technological shift, market participants are experimenting with different tokenization models, and I'm interested to hear the panel's thoughts about the implications of these approaches. Several models may warrant discussion. First, some companies are issuing equity directly on public distributed ledgers in the form of programmable assets that, in some cases, have the ability to embed compliance, voting rights, and other governance functions. This path allows investors to hold a security in digital format with fewer intermediaries and more transparency. Second, third parties are tokenizing equities by creating on-chain security entitlements, which represent ownership interests in equities that exist off-chain. And third, we are seeing synthetic exposures, tokenized products that seek to mirror public equity performance. While today the offer and sale of these products are proliferating offshore, they illustrate the global demand for U.S. market exposure built on distributed ledger-powered infrastructure. Of course, the shift to on-chain capital markets requires more than just issuance. We also tackle other chain stages in the securities transaction lifecycle. For example, tokenized shares risk becoming nothing more than conversation pieces if their owners cannot trade them competitively in liquid on-chain environments. But making this possible requires the Commission to think carefully about how our regulatory mandate intersects with technological realities. Furthermore, that these new systems work effectively and align with overarching goals of transparency and investor protection. The previous Commission attempted to address on-chain markets through a brute force redefinition of exchange to include even basic communication protocols, and then subjecting whatever was captured by that new definition to the full panoply of our regulatory framework for exchanges. That approach lacked limiting principles, expanded the SEC's reach beyond what Congress intended, and ultimately created uncertainty that chilled innovation. So we must not and cannot repeat that mistake. If we want to boost innovation, investment, and jobs here in the United States, we must provide compliant pathways that allow market participants to leverage the unique capabilities of this new technology. That's why I've asked staff to recommend to the Commission ways in which we can use our exemptive authority to allow for on-chain innovation while we continue to work on long-term, durable rules of the road. Congress has given the SEC broad exemptive authorities under the Securities and Exchange Act of 1934, and we must use these authorities responsibly. A thoughtful exemptive framework, cabined, time-limited, transparent, and anchored in strong investor protections, could allow the markets to develop on-chain models and give investors innovative new choices. And drawing on input from market participants, we will be able to craft rules that distinguish between truly decentralized finance and the wide spectrum of centralized on-chain finance in existence today. A durable rulebook must recognize this spectrum without forcing square pegs into round holes. If we attempt to regulate decentralized protocols as if they were centralized brokers, we will undermine the very innovation that makes them resilient and transparent. But if we allow centralized intermediaries to benefit from regulatory arbitrage just because they operate on-chain, then we erode the principles of accountability and investor protection that have contributed to our global market dominance. Our task, as well as our responsibility, is to write rules that match functional reality. I look forward to working with my counterparts across the administration in the coming years to do just that. The SEC's role is not to resist the market's transition to on-chain capital markets, nor is it to force it into legacy definitions, nor to push innovators offshore. Rather, it is to allow market participants to operate and innovate subject to clear guardrails that protect the public, ensuring that U.S. markets remain the most dynamic, transparent, and trusted in the world. If we stay true to this course, we can ensure that the United States leads, not follows, in the next chapter of capital markets innovation. And finally, just as tokenization represents one evolution in our markets, so does the subject of the recommendation that the committee will be considering today. The advent of artificial intelligence promises to transform workflows and business models. Yet with every emerging development, the question for the SEC to consider is not necessarily its novelty, but whether our existing disclosure framework sufficiently provides investors with material information about it. And on that point, I believe that investors can rely on our current principles-based rules to inform them of how AI impacts companies. Indeed, we should resist the temptation to adopt prescriptive disclosure requirements for every new thing that affects a business. Our principles-based rules were intentionally designed to allow companies to inform investors of material impacts of any new development, including how AI affects their financial results, how AI can be a material risk factor to an investment, and how AI is a material aspect of their business model. These rules have stood the test of time because they rely on the fundamental principle of materiality rather than on ever-expanding checklists. As we consider these topics together, I'm grateful once again for the rigor and the thoughtfulness that you all bring to every Investor Advisory Committee meeting. Your collective expertise makes this committee an indispensable partner in safeguarding investors and strengthening our markets. So thank you all for your time and your engagement today, and I look forward to the discussions ahead. Thank you very much.
Thank you, Mr. Chairman. Thank you very much for those remarks. We will now pause for lunch and our IAC executive session. The public segment of the meeting will reconvene at 2 p.m.